Yeah, hi. I can hear you, Prince. Can you hear me?
Yeah, yeah, loud and clear.
Perfect,
Great.
perfect, perfect.
Come again, sir.
Yeah, thank you, thank you. So maybe let's give everyone few seconds and then we'll kick off.
Right, sir. And guys, as I said sometime before, the session is purely educational. The intention of this sector is to become a more informed investor. Please take today's discussion as a starting point for your further due diligence. By no means any names taken during the conversation would be construed as buy, sell, or hold recommendation from our end. We are not SEBI registered, and it would be wise on your part to consult your financial advisor before making any financial decisions. And the questions should not be you need not indirectly, if you have done some homework on your part and you are broadly discussing some business sense, then the questions might be taken, and my DM would be open for that. You can simply type in the questions and I'll read it out to Sajal sir. And yeah, Sajal sir, you can, as and when you are comfortable, you can start with your opening note and then we open the floor for questions.
Yeah, sure. So I shall start with so hi everyone. First of all, good to connect again. I shall start with a rather boring anecdote, but I promise I shall keep it as short as possible. Um, So, investing, as we know, is all about betting on the future that's uncertain and unpredictable. Um, the world is getting increasingly fragile, and we don't know what we don't know. That's for sure. So, from my own personal experience, I mean, years ago during my MBA days, there was a false confidence that I can see the future, as I can do all sorts of number crunching. Um, I used to work on creating those, nice looking DCF forecasts, and it was so exciting to assume the cash earnings amount and growth rate and flexing the hurdle rate and changing those discounts to the terminal cash flows, etc. It was great entertainment, but it never worked. Um, and over time, this quote unquote clinical trials that I performed with discounted cash flow models proved that the future is unpredictable, and I would be too naive to base my thesis on this number alone. Uh, I'm not suggesting that we should not forecast the future, because we are all betting on the future and that's where the returns are. But our forecast should be ultra conservative. If at all we must forecast the future. Um, so the key question is that now, as the future is unknown, uncertain, unpredictable, how the hell we figure out what will happen 5 years out? Because that's where we'll make those large gains, or we'll not make any gains, or we would be sitting on losses. So it's all about betting on the future, which is uncertain and unpredictable. So uh, my mistakes and lessons have taught me that the best way to forecast the future is to go back in history. Read history, learn from history, focus more on the history of people running the show rather than the show itself, because the show will change. So focus more on the people behind the business. And yes, we all know that history never repeats but rhymes, right? And focusing specifically on the small companies universe, because that's the focus of today's discussion, they tend to be far more volatile and in both directions, so both northbound and southbound. They move, you know with high speed in either direction. So in screening small and mid caps, much more than the larger and well established companies, we ought to study the people behind those businesses, study what they have done in the past. If they have executed well in one business segment or another company in the group, and today they may be leading a smaller business or creating a new business, that history gives me the confidence to bet on that jockey. So 20 years back, I was very early in my investing journey, and there was a very small API company called Matrix Labs. And this is, I'm talking about 2002, 2003. So it's unlisted. Matrix Labs became, was acquired by Mylan Labs later on. But this stock, and in those days when you are very young and early on in your journey, is the stock price movement that is so very exciting. And I remember within 18 months or so, Matrix Labs just exploded. The stock was a very big, 20 bagger or something, in a jiffy. So if the management, it may not be the CEO in that business, it may be chief operating officer or senior management, um, who was contributing in that growth story. If that management is now running a different company, uh, then we got to get serious about that business. And it was the journey of Matrix Labs, the sudden explosion, and Divi's Labs IPO came around that time. So, and there was no bull market in APIs or chemicals or pharma in that period. So I'm talking about 2003 to around. Bull market, if at all, was into infrastructure, domestic, inward-looking businesses, so to speak. So, what happened around Matrix Labs and the IPOs that were coming out from pharmaceutical API space during that time sucked me into this chemical and API universe, and that's how I got more interested in the small caps. So I started researching other businesses. So Atul also came on my radar around about 2003 2004. So that's how I understood more about the quality of the people behind the business. Now, on the flip side of this, capable, ethical, and growth hungry managements are the crooks, and there are a lot of crooks in India. Majority of these small cap businesses, I mean, that's how I initially approach each and every small and mid cap. I i assume that the management is not ethical. I assume that management is incompetent, and once I've done that assumption, I look for counter confirmatory evidence that I'm wrong. So my soft signal is always out, and then I look for evidence that it's not out. So I start with a very sort of conservative, pessimistic mindset. Right or wrong, I don't know, but it works for me at least. And the reason, there are so many managers, they cook those numbers, they would inflate earnings and create a feel of carnival just to fool us, because they are just looking for a 1 year, 6 months, 18 months kind of a time horizon, um, to pump the stock, just show the numbers, because everyone is looking for EPS and PE, right? And it's easy to fudge those numbers. They are very creative accountants all over. You tell them how much you want to generate as earnings per share on the accounting P&L side, and they'll do it for you. So we as investors cannot deal with unethical management, period. And we have seen private equity players with all the muscle power failing to deal with suboptimal management. So you look at, I'm talking about pharmaceutical space, you look at TPG, you look at Carlyle Group. So when private equity with all the muscle power and the resources, if they are struggling, how can an individual shareholders with absolutely no sort of power to influence the management and make sure that they do the right thing, we absolutely have got no chance. So the only way to deal with crooks, in my view, is to completely avoid them. But a lot of time we only realize who is an incompetent idiot later on, when we start partnering with them, or we onboard the stock, and we start experiencing the management bit more closely. And there is a very famous quote that I remember from Charlie Munger. It's quite famous. You would have heard about it, read about it many times. He says, so Charlie says, and I quote him. He says, "Never engage in a wrestling context with a pig, because you both would get dirty, and the pig will enjoy that." So that's how, this dirty management, and majority of small and pharma always start with that perception that, it's a dirty management. And however, many times we do discover, who is bankable and who is worthwhile, in terms of competence and capability, so that we can get on board and start traveling with that same management on the same bus over a period of time. um, and I agree, it's time consuming to risk assess the quality of the management team. You need to check their background in terms of, their education, their past work experience, see what they have delivered in the past. And I've said this before, that balance sheet and cash flows over a period, not last year or the year before, over a period, balance sheet and cash flows are a good proxy indicator of the quality of the management. That's the sort of context I would like to set. And just to repeat, if you've got any questions, um, just reply, and Prince Accidental Investor will be monitoring those. But make sure you ask questions that help everyone. it, I want to learn from your questions as well. I want to improve as an investor. So mention everything that you know about that management. Mention what is it that you don't understand about that management, and also mention what research or homework have you done on this idea. Because as I said, we have to take this as an ecosystem of learning. And if you ask, genuine questions, if you detail them, we'll be able to prioritize those questions. And I would rather focus on sectors that are less spoken about, at least from my perspective. So anything which is not related to chemicals, not related to APIs, pharma, and not related to hospitals, etc., etc., I think those questions should be prioritized. And lastly, just to repeat the disclaimer, if any stocks are being mentioned, is absolutely no recommendation. I'm not a registered advisor, and I'm not here to handhold you, or influence your buy sell decision. Thank you.
Sajal sir, am I audible, right?
Yes, yes.
Yeah. So Aniket has one question, though very basic one, but again, he's asking how a newbie investor should analyze a good management. What could be a best framework or maybe a thing to start with?
Yeah, so again, as I said, you need to go back in the history. What was this person doing previously? And if they haven't managed any business, what's their education background? So many years ago, I'm talking about 2012, there was a very small company, Aztec Life Sciences. I didn't know much about the promoter, Ashok Hiramat. um, so I looked up, I did googling, and I figured out that he's from Oxford. He's done his education there, and I got hold of some YouTube videos. You got to see what do you do when you go and meet someone for a relationship. It could be a date, it could be anything. What attributes you look for in that person? You look for character, you look for competence, you look for energy, ethics, so on and so forth. So again, try and validate those key attributes in any person. Don't get too much hung up about the business as such, because there will be very limited information on that small cap. And if the person is credible and trustworthy, they will figure it out. You don't have to. So if I take chemicals as an example, you don't have to understand each and every molecule, but the management should be able to. The scientists who are working there, they should be able to understand, and they are my proxy. So research as much as you can on the background, then look at the balance sheet and the cash flows. What have they done over a period of, let's say, 5 years? What was the operating cash flow in 2015, 2017, 18 period, and what's the operating cash flow today? What sort of gross block they have added, what are they saying if they are doing, earnings call on a quarterly basis, what's their thought process, why they are saying what they are saying, is it in line with the competitors commentary or is it not. So you have to have, it takes a while to complete your research and due diligence, and there should never be any rush to take, a 5% exposure in a jiffy. Take your time, because if it's a longer term story, if the management is good, capable, trustworthy, the compounding will happen. It may not happen over the next 2 years, but eventually it will. That's how I would address that. But good question.
All right, sir. So Jilani Sheikh has a similar question. So he is basically focusing on when once you realize the capability, honesty, business acumen, capital allocation, etc., etc., you may lose some initial run up. But is it not such risky, sir? Your opinion? So
Sorry,
basically, he's
can,
asking
can you can
about
you repeat?
yeah.
Yeah, what's the
Ah,
question?
so basically, he's saying a sense check on the management has been done, but doing so will take some time, right? And in the meantime, the company has some initial run up. So he's focusing on that. So is it fine or how it should be
It,
viewed?
yeah, so it
This is the
it
question.
correct. So I now, so once you have done the due diligence on the management, and you are convinced that it's a trustworthy, bankable, ethical, capable, growth hungry management and all the rest of it, so all those boxes are ticking, then valuation is also an important function of your return, because ultimately if you buy a great business with a great management at expensive valuations, you will unlikely make any gains, at least in the short term. So then you need to figure out, what is in your eyes the true worth, or how much market cap should this, or enterprise value including the debt, should this business be selling at. And if even after the run up, if the valuation is are nowhere near your best estimate, then arguably you have got some margin of safety. And if the stock has run up and the valuations are not favorable, you can keep tracking this story. There are 6,000 odd stocks. I'm just talking purely from India perspective, right? If you don't find this one, because you have done so much research on this business, it's a learning. So you have got your returns actually already, even without investing in the stock. You have got your returns because you now understand the process of screening the management, and you can apply the same process elsewhere. You can't be unlucky every time that you took 3 months, 6 months, whatsoever, to research the management and the business, and the stock is up. It won't happen every time.
So another question is from Dilip sir. So he's asking the cash flow and balance sheet can also be managed as it was done in the case of Satyam. So here we don't have the liberty to know more about the company too. So how to avoid such situations? So basically,
Correct. And excellent question. Satyam, perfect example. How many Satyams have happened in the IT industry, or corporate in
was I
India for
audible,
that
sir?
matter? Yeah, am I not? Can you hear me, Prince? Hello.
I think we can hear you. You can go ahead, please.
Yeah, yeah. Hi, Jitin. Hi. So I'm just saying that that's a good example. So this is, I would say, this after you have done the due diligence and everything, the balance sheet, and the question was the balance sheet and the cash flows were first, and so accidents would happen. See, and that's the reason we make a portfolio. We don't bet 100% on one or stock, or 50% each on two stocks. We create a portfolio, especially in small caps. You got to have at least 30, 40 stocks, because you don't know what you don't know upfront. No one knew what chemicals as a space would do 10 years out back in 2010. But if you use the process to get on board with good looking micro caps, so SRF as an example was below 1000 crore market cap. There were many examples: Viniti, Naveen, Deepak, Atul, all sorts of examples. And Satyam won't happen in each of those cases. Yeah, you will find, one odd instance where something bad happened, and that's the reason we are creating a portfolio. And power of compounding will take care of that. So if you buy a stock at 100, it may go to zero. The downside is 100%. But over a period of time, 100 may also become 10,000. So if your process is right, the outcome can still be bad. But that's you've been unlucky there. Flip side is also true. You may not be having any process. You're just following the momentum. You took a stock tip, it was a punt, and it worked out beautifully. And you may think you are a champion. You're not. You're just lucky. You had good luck in this scenario. Previously, you followed the process. The outcome was not good. That was your bad luck. You cannot see, but the point I'm trying to highlight here is, long answer short, you cannot control the outcome. Control what you can control, and you can control the process.
Hesitant, sir.
Yeah. So, if I may add, for specifically, let's say two examples like Satyam. For example, if you look at the balance sheet properly, if you look at related party transactions and all that, I mean, I'm sure that somebody looking deep would have found holes into that. For example, the Mayfair or whatever the interest subsidy was there, investment there. So I'm just saying that if we dig deep enough, and as Sajal also mentioned, if you go through a number of annual reports, conference calls, you can make out of the how the management quality is. I think practitioners who have done this for a long time are able to do that. If they have the experience, so it all comes with experience. You generally know what to look for, and so on. Very difficult to explain, but yes, cases like this, I mean, if one looks at the balance sheet and the annual report properly, I think this can be found out. I, being from the software background, sort of never invested in Satyam because apart from these, there were other things, about Satyam, which were known to people in the software industry. I mean, you generally, I mean, I'm not saying that you will always be successful, but then yes, even this kind of things can be avoided if you dig deep enough. That's my limited point.
Right, sir. So, Sajal sir, next question is from Vardy. He's asking, is CSR where they are donating whether relative NGO? I'm not sure.
Sorry, your voice is breaking, Prince. What's
Let
the
me.
question again?
I couldn't get the whole question, so let me read out the other question. So, how do you manage to research so many companies on your own single-handedly? Are there any productivity tools and which you use to make this more efficient?
I mean, yes, there are productivity tools like Screener is there. There's Tijori Finance. Um, so I think those are good platforms, because I won't be able to remember all the data off the top of my head. So I frequently visit these sites. I see all sorts of data, from balance sheet to cash flows to profit margins, and I also compare with the peer set. If two businesses are in a very similar business, one is reporting an EBITDA margin of 40%, the other one is at 15%. I then try and figure out what's the reason. Is there sort of heavier fixed cost? So they've got more scientists, they've got additional capacities that are not up and running, so they've got certain units that are operating at negative EBITDA. Because what you see on the screeners, or Tijori Finance is just the blended number. Unit economics could be very different, right? So it's same for API companies, same for chemical. You have got 5 units, two are negative EBITDA, three are 35%. You get the blended at 15% or thereabout. So if you understand this space, you understand the sector, you will be able to figure out the reason why the numbers are where they are, and what could potentially cause those numbers to improve, and not only improve significantly. And I've seen many cases. So SRF is one example. Na? The look at the EBITDA margins, historic EBITDA margins, and look where what they have created. And many such examples where, and I know many companies. So I've been tracking Newland Labs for years and years, and disclosure that I'm invested is not a recommendation, but they had 30-35% gross margins, and they started hiring scientists and doing all sorts of research, and and the margins were very all over the place. But you see the trend in the gross margin over a period of 10-15 years. So from 30-35%, if the business is going to 60%, um, the economics of the business have improved. And I knew that I was following DVs and many other companies, that the economics of this custom synthesis business is such that the gross margins have to be at a certain range, and when your capacities are fully up and running, your operating margins will be at a certain range, give or take. So your experience also helps you in due diligence. And even with the experience, I'm not saying that mistakes will happen. I will make so many mistakes, even going forward, but that's the nature of the beast. If I bet on, even today, in this current market, when everything has been busted, especially I'm talking about pharmaceuticals and chemicals in particular, there's a lot of stocks that are down 60-70%. If I use my best process and all the awareness and everything, and if I pick 10 of those stocks, only two or three will go and do wonderfully well. Why is it so? Because that's the nature of the beast. Future is unpredictable and uncertain, and there will be many things. Managements will change. Good managements will be booted out. We saw that in Sequent, right? Good managements will leave. Your thesis will have to change, because ultimately, see, Phil Fisher says 90% of the thesis hinges around management. 90%. That's Phil Fisher. And even then, people like Phil Fisher, Jack Akri, Munger, all of them, we all make mistakes. So if our processes are so solid, why do we still make mistakes? Because we are betting on the uncertain future. Outcome is uncertain.
Another question is, sir, what would be a good valuation matrix if we say IT companies and ER&D companies?
Again, so valuation is a function of all the moving parts, and what sort of management team that they have, what is the culture in the organization, what is it that they're trying to address, what are the entry barriers, um, so on and so forth. So you cannot put a hard number. See, if it's that simple, that you give me the business on the sector and the industry, and I'll feed that data in a tool or a platform, and I'll get the ideal valuation. If it was so simple, then only algos will be doing trading or investing. Humans will be out of the business. So it's difficult to, but yes, if something is an outlier, that it doesn't make sense, that if it's a great business and the margins are nowhere in line with where they should be, that's a red flag. If it's an average looking business and P&L is giving you a very rosy picture, whereas the cash flows are not in sync with the EBITDA, so you do that EBITDA to cash flow conversion, and you figure out that it's the conversion is not just not there. So you'd have to look for certain signs, Um, Typically, I mean, I generally tend to give a higher price to book value to businesses that are IP related, and definitely ER&D company is one such, because it's human capital rich business, right? You will not be able to find these businesses at one time price to book or two times price to book. You should be prepared to give such businesses, assuming all things are great and all boxes are being ticked. You will find these businesses at 7, 8, 9 times price to book, possibly.
Right,
So
sir.
again, your industry knowledge, background, etc., everything will have to come into play. Your past experience, your process, you keep fine tuning your process. So it's difficult to put a hard number basically on valuations. It's very subjective.
Right, sir. There is one question from Devkrit. He's asking, he has been studying a sub 100 crore market cap company in the manufacturing space. The management had made very ambitious calls like they will double the sales next year and cross 100 crore in sales by 2023, which they failed to materialize, but still they increased their sales by 50%. So should this be looked as a growth hungry management or it's a red flag?
No, I wouldn't necessarily call it as a red flag. There are many moving parts. See, the world is very fragile. If the management said that they would double the top line in 2 years, 3 years, or whatever, and if they fail to do that, I would rather go and figure out, what were the reasons. And this happens all the time. Even Lotus Labs, they gave 1 billion um, forecast. They couldn't make it. So you need to figure out whether it's a red flag on the management, or is it is it the nature of the beast where the world is so fragile. I mean, war, everything is happening, geopolitical, whatever bad could have happened has actually happened in the last 12 to 18 months. So you have to look everything into the context. I'm not saying that the management is honest or dishonest, but you have to do the why analysis, that why the numbers didn't show as expected. And if you figure out the reason, and if those reasons were kind of controllable, so there is an internal element in the business, and there is an external environment. Your resources and capabilities, your balance sheet, cash flow, the kind of people, the kind of talent you have, the kind of management team you have, that's all internal. But that's part of the story. There are competitors, you have got suppliers, you have got customers, you have got your all the geopolitical and all the rest of it. And it's a sum total of everything. There's a million moving parts.
Another question is from Kailash. He's asking, how can we ensure that management is handling cyclical price pressure properly to maintain the operating profit margins?
Not 100% sure if I got the question. I mean
He's asking, how can we ensure that the management is handling cyclical price pressure properly so as to maintain the operating profit margin?
see, pricing in any business, or most of the businesses, is a function of demand and supply, both. So if you take sugar, paper, any cyclical sector for that matter, or even generic APIs, pricing is a function of many things. Is your raw material, is your manufacturing expenses, power, fuel, your logistics cost, then what's the competitive intensity. So many players may be making the same product, jostling for the market share. What is management doing? I mean, are they investing in research? Are they trying to improve the product basket? There are many moving parts to this question, so it would be difficult to pinpoint whether or not the management is at fault. It depends on the wider industry and landscape, and what corrective actions, if any, the management has taken to sort of improve their competitive positioning.
Another question is from Vardy. He is asking the corporate social responsibility indicator where the company is donating to the relative NGOs should be viewed.
Hi, that I think is a gray area that you need to further do an enhanced due diligence, if I could use that term. Because if it's sort of a related party, your NGO is also owned by your brother or sister or your relative, and you are doing CSR because you have to, then yes, you would have to do some enhanced due diligence and figure out, why is it that they are favoring that NGO or a social cause over other, and if you don't have access to the management, and if it's a business which is not doing quarterly earnings calls, so you don't know what's going on in the business, then often it's better to avoid and wait on the sidelines, because the opportunities will keep coming. It's 100% correct to let go some opportunities, so that you hold cash for the next available train. Buses will keep coming, right? You don't have to board the next available bus, you can wait.
Sumit Chopra is asking, how do you rate qualitative triggers in small and micro cap, such as management is spending on shifting to big offices, implementing SAP ERP system, hiring large number of employees, while still not visible in sales.
Yeah, so it's quite possible. There are many businesses where you have to invest upfront, and there could be a 5 to 7 year lag before you see any revenues or any sort of cash being generated, and that's the nature of the beast. And again, you have to understand, you have to have some understanding of the sector. In certain sectors, 5 to 7 years of gestation period is pretty logical and acceptable, and that's the reason you wouldn't find too many players in that kind of a space, because no one has got the capacity to deploy and put assets on the ground 5 to 7 years ahead of the curve. So I don't know which sector or which industry this is, but in certain industries where, see, certain industries where the the business is asset light. So consulting as an example, I can start an infrastructure consulting business with just 5 employees or 4 employees, with some investments in IT infrastructure, and I can be up and running, and I'll start generating cash. But because my business model is asset light, competitors can easily enter as well. Whereas imagine a scenario where you have to set up 1,000 crore biologics plant upfront, before you can even innovators will not award you any contract. How many companies will have that capability and courage and foresight to deploy 1,000 crore? So that's the asset intensity is where the entry barrier is in this case. So again, it has to be looked into the context of the economics of that business. Is it an asset light business? What kind of business? Can it get increasingly competitive? And if the entry barriers are shallow and low, then no point investing in such a business, because there will be a smarter management, or the competitive intensity will increase significantly. It may not be heavily competitive today, but you're not betting on, yeah, trading is fine, 1 week, 2 week, 1 day, 2 day, but if you're betting on a business for 3 to 5 years, you have to make sure that the entry barriers are significantly high. You also need to make sure that the exit barriers for the customers are also high. I don't want to get into a relationship with a customer where my customer is very price sensitive, and it's easy for my customer to switch the suppliers. I don't want to get into those businesses, because then I've got no pricing power.
Right, sir. So Raghav Singh has a question for small cap portfolio. Should we remain fully invested or take money off the table around peaks because small caps can correct 50 to 70% as well. So is it wise to in the long term? Skimming the fat. Okay. So basically, he's asking small caps can see big correction. So is it wise to book the profit near the peaks and
Yeah, if you the answer is yes, but you have to know what is the peak. If you know the peak, if you know that the story is too good to be true, then yes, of course, I mean, you should not be trimming, you should just exit that position, because there will always be something better at a reasonable valuation, better business, better management, to reinvest that cash. Absolutely.
Vijay is asking if the management is good, but the business is having temporary trouble due to weak demand or increase in raw material cost. How much quarters or years will you give for the management to perform?
So I say that one more time.
So basically, he's saying if the business is good and there are temporary headwinds or increase in raw materials, so in such cases, how much time, maybe in the quarters or years of time, do you give to the management so as to prove themselves?
So I will look at the competitive landscape, what the competitors are saying or doing, and then I will assess the management, in that with that information or with that knowledge. And if I figure out that everyone else is comfortable, well placed, and the problem is specific to this business, then that would raise some sort of a orange flag, if not red flag, and that would require some further due diligence and cross verifications, etc. It may be just that the whole industry has suffered. So pharma, as an example, every company has got challenges with the US FDA. So then I try and figure out what are those companies that are not getting mm, those challenges, or or they are also being inspected and audited, and they are coming out clean. So that means that and it's very common in pharmaceutical industry. The larger the business, the more complicated it gets, and majority of the challenges are with the large caps for that reason, that they are fundamentally more complicated. Smaller businesses who are undertaking external audits on a weekly basis, they are much more prepared. So these many of these API companies, they get frequent audits from their clients, versus the end-to-end integrated player, who is just relying on their own internal audit. Yes, Prince.
Yeah, another question is around the sugar industry. So the question is around do you track the sugar industry? And if yes, if we what we say, if we keep aside the ethanol story, how should it be viewed? Or ethanol story is more noise and less on ground. How exactly you see the sector?
Yeah, so far, I mean, ethanol is I've heard a lot, and the blending has also gone up, and I think I addressed that question in the last year's spaces as well. That a lot of the ethanol stories around the government support and all the rest, especially in India. Yes, there is a green initiative even in the, so in Europe here, we have got blended. We have got 5% and 20% blending, and it's kind of clearly marked, and you don't have a choice. You have to either go for 5% blended or 10% blended. So ethanol globally is there, but especially from India perspective, a lot of it is a function of how much support you get from the government side. On sugar, I think we have got Jatin here. He is the best person when it comes to tracking all sorts of cyclicals stroke commodities. So I would invite him to just opine on, where he sees sugar industry going forward, because I must admit, I'm little less informed when it comes to these commodities.
Yeah, yeah. So, thanks, Sajal. I've been enjoying all your answers. Very, very good answers to all the questions. So, sugar, I mean, we have to understand that, uh, sugar is very, very much dependent on the government. So, uh, the whole ethanol story is because there was a push from the government and fairly decent prices were being given for ethanol, and the whole basically, that's why, despite lower sugar prices, acreage has increased and production is higher. So I think it is poised well enough. I think blending will keep on increasing. I think government support will be there, at least till the present government is there. So I mean, you will also have to take a bet politically. I don't know how much, how, if the government changes and policies change and something like that is a risk. Uh, so you will have to take some sort of political call also beyond 2024. Uh, and I think we will end up with a lower closing stock than what was last year, despite the higher production and all that, because a lot of it is going through to ethanol also. Some of the companies, I mean, I will not name any right now, obviously, but some of the companies have corrected quite well. And I mean, I think it's a sector which can be looked at. Uh, but the risk I've already told you, I mean, there is a political risk. So make informed decisions based on that. But I think the green story will continue. Blending in ethanol will continue. So it is it is cyclical, but far less cyclical than what it was, in the previous cycle and so on. So there is some structural story towards ethanol. And now you have to figure out, how much of the revenues and how much of the profits are coming from the distillery and ethanol business in each company, and take calls accordingly. So that is a very important thing to do.
All right, sir. Thank you. So, Sajal sir, another
Thanks, Jatin, for a very, very worthwhile answer. Thank you.
Another question is around the railway theme and defense sector. So we are seeing, large order books in the sectors, and there are so much talk in the town about these sectors. So do you see that is really panning out in the numbers for the companies, or it's long story? How exactly you see the space, the railway and defense sector?
So in general, I'm reasonably positive on both. So defense is a global theme. Is you may just be looking at India. It's playing out globally for all the reasons, like from geopolitical, and there is always that looming threat that some sort of conflict may get escalated above and beyond what's currently happening. Uh, the the economics of the defense business is such that from actually participating in the bidding process to getting the product developed, manufactured, um, delivered, and then getting the payment back, it could be a very long cycle. It could be a 5-year cycle, it could be a 7-year cycle, if not longer. So you have to be mindful of the cash cycle of any sector, and defense is a notorious sector globally, um, from the cash conversion cycle perspective. But other than that, there are significant tailwinds, as I see. A lot of businesses are already doing well. The numbers may not be visible upfront, for the reasons I just explained. But if you ask my honest opinion, for whatever little I understand, looking at this space globally, I think this tailwind should sustain. But again, as I said, you got to be mindful of the balance sheet, and the cash, operating cash, free cash profile. And don't just value them on PE basis alone. So that's on the defense. Railway, I think, is a much more domestic. Again, it's a global theme. There are a lot of infrastructure issues worldwide, but I think from India perspective, railway is the lifeline of masses. You can be having, 1,000 airports, and a lot of people are using domestic flights, for point to point commute. But I think railway is 70% of India's population, guys. Like it or not, is still sub-Saharan. We are still fundamentally a very poor country, and we rely on railways. And there's a lot of improvement that has already happened. When I traveled to India, I experienced those changes, and these are all positive changes. You look at the cleanliness on the platform, and the kind of um, punctuality, unless there's a fog or anything. I mean, as far as my understanding is, what I have experienced, the trains were running pretty much on time, give or take. And the platforms are looking a lot cleaner, the tracks are looking a lot, because of these bio toilets and all the rest of it. Then you need to constantly upgrade your bogies and carriages, because a lot of our infrastructure is kind of pretty dated. So I believe that the railway infrastructure, if I could pick one pocket within the infrastructure space, I would go for railways, because there is government backing, and government capex is the only capex where I think there is some degree of certainty. I'm not convinced. So chemicals capex, I'm convinced. API capex, I'm convinced, and then government capex is the other one that I'm convinced. I don't see any other private big participation on the capex front. So if you have to play infra or capex theme, then I think railways is also a good option. I mean, there are many. I don't want to name any stocks, because then the discussion or the focus or the attention shifts from the business economics to the stock economics. But I think that there are valid reasons to be positive on both these spaces. I've got a hand from I think Jatin. So yeah, you would definitely be. I would love to hear your views as well.
Yeah, so Sajal, I think you gave a very good answer, and yes, we I track both these sectors very closely. Uh, so, as if you ask me, the time to invest in defense was about 15, 18 months back. To be honest, a lot of run up has happened. So, yes, I think these companies will do very well for a long period of time. But then you also have to look at margins and the growth. I mean, see, it all comes down to that. Do you want to pay 30, 35 times for companies which will grow at 15% for a very long period, and they being PSUs? I mean, for a private company, yes, people would take that call, but for a PSU, would you take that call? That is something which each of you have to think about. I would not. I would at the most hold them. That's my view on a lot of the defense names, without naming anybody. The railways, I think, looks, I think valuations are still very much in favor, and I think growth story there is also equally strong. So I would also concur with Sajal, that I think railways would be a better place to invest if you were to invest now than defense. Most of the names are PSUs, in defense, which you would like. I mean, there are some others, but then they, uh, are very highly valued. So I would look at railways, and also you have to understand that margins will always be kind of capped for these companies. So how much valuations uh, you have to give to these companies is something each one has to decide. But that is my view on both the sectors.
So Jitain and Sajal sir, the risk of the government which you enumerated for the sugar industry also remains in both the sectors, despite being the very vital sectors.
Exactly. I mean, that remains in all PSUs, obviously. So, but I think yes, if I mean, without being political, if there is a change, then yes, I think some of this focus might not be there as much as it is now. Is what, and then derating can happen quickly. So that is my view. I mean, again, I might be proven wrong also. Who knows? But then, few things I think will continue. Generally, governments will not tinker with awards which have been given, which are very long term contracts. So, but then the pace might slow down or something like that might happen. We don't know. We know what happened previously also in infra and all that. So, yes, you have to see what will happen with the continuity. So that is the risk.
Right. So, Sajal sir, next question is around electronics contract manufacturing space. So, do you see that space positively, or because the margins in that space are very less compared to other contract manufacturing space, and obviously it is all scale game. So, any view on this from your answer?
Yes, no, absolutely. See, my understanding is that there is a large outsourcing wave. You could call it Word plus one for India. What drives manufacturing? What drives outsourcing? A is the scale, the cost, um, including the logistics. So you are making in an offshore destination, thousands of miles away. You need to ship that product. So there is a cost angle, cost arbitrage there, including the logistics. But there is also the function of finding the right set of people. So if it's a assembly plant, then you don't need that level of skill or competence. You just need the labor or the workforce. You still need to train them, but the gestation period or the skill set that you need is not like doing custom synthesis or drug discovery research. So that's a different, completely different level. So that also means that India as a country can also be displaced by some other geography. If not if not today, maybe tomorrow, because if it's just a function of finding the right amount of people, training, giving them 1 week 2 week kind of training, that how to handle the assembly plant, and that kind of work is required, which is a low entry barrier work, then someone else can also displace you. I generally don't invest or don't like such industries. I like, the reason I like pharmaceuticals and chemicals custom synthesis is there are not too many countries where you can hire capable IIT level scientists, and you can hire them in the right numbers, and then you can get on with the product development long lead cycles. So that way there would be very few countries who would be able to compete with India. So cost will not be the sole criteria here. It's the is the capability, getting the right mix of scientists, so on and so forth, which is inherent to this industry, right? I mean, look at PI Industries as an example. They have been trying to get into the pharmaceutical custom synthesis space for about 8 9 years, and they've not been able to scale it up. Whereas when I see companies like Laurus Labs, Newland Labs, Syngene, so on and so forth, they have brilliantly scaled up the custom synthesis, and some of them are now venturing out into the terrain which was traditionally held by PI Industries, the agro synthesis. So again, no recommendation, but Laurus will be starting, full commercial scale agro synthesis in next couple of years. So Laurus was able to enter PI industry stuff. PI was not able to enter significantly into pharma. They may be doing few crores here and there, but by and large, the it kind of tells you about the entry barriers as well. So it's easy to do the custom synthesis on the agro. It's not easy to do the custom synthesis on the pharma side. The the equation is very different. So coming back to your question on electronics, yeah, the entry barriers are lower, and that's the reason the margins are where they are. If you get into the high end semiconductor synthesis or the high end manufacturing of electronic chemicals, that kind of, there the margins would be significantly different, better, more sustainable. And I would be interested in those pockets where technology is a big entry barrier, where finding the right skill set is a big entry barrier, where finding not just the right skill set, the number of people with that skill set. And those are the industries where there will be a much more sustainable run. Anything you would like to add, Jitin, here?
Jiten sir, any view on electronics contract manufacturing from your end?
I think I missed the question, so it will not be possible for me to reply. Uh,
Okay.
I had got a call,
Okay, sir.
so
No
sorry for
issues.
that.
No issues. So, Sajal sir, next question is on the basis of revenue cornering and core capabilities out of mid cap and large cap IT companies, which one you will prefer and why?
So I would prefer, regardless of whether they are small cap or mid cap. I don't know what is the definition of. So anything less than 5,000 crore market cap is a small cap for me. Anything above 30,000 crore market cap is kind of a gray area. Definitely, um, 35,000, 40,000 crore market cap is a large cap, and anything in between is a sort of a mid cap. Um, Rather than getting too hung up on the market cap, I think it's the economics of the business. What is the nature of the business? How domain centric it is? How knowledge centric it is? And how sticky it is? So there are some good companies that are into subscription model, licensing model of the software, and they are into all sorts of automating the business processes, automating compliance, automating your risk assessments, automating your audits, and they go in with a 3 to 5 year contract, and there is an annual recurring licensing income or subscription income that gives me the assurance that the cash flows are here to stay. And then on the other side, from a customer's perspective, once you have onboarded a new software, you train your staff internally to use that software, improve the efficiency and productivity, and you don't want to repeat that exercise every other year. So there is a inherently there is an stickiness. It's a bit like the custom synthesis of NCs and biologics. Once the molecule is commercial, you don't want to switch the supplier because the patent clock is ticking. You don't want to take that pain, and you don't want to take that risk. Likewise, in that software business, you know what, you will not switch the supplier purely on price. And typically these contracts get revised every 3 years, or whenever they are due, and there is at least an inflation adjusted price increase. So the licensing income keeps coming, and then depending upon the contract, there may be clauses where, if you're looking for some sort of enhancements or bespoke development, then that's a TNM, time and material. So that's above and beyond, and the customer is captive. Customer is not going anywhere. So these type of models are there today in India, on all small as well as mid-sized companies, and that's where the entry barriers are because the customer, this the relationship is sticky, and the cash flows are also sticky. So I would prefer to be around these pockets in the technology stroke IT space.
Right. Another question is around management compensation. So how it should be viewed? Because people are saying if the management is good, it should not take much of the compensation. And contrary to which, if the one point of view is like if the management is good, they can take good amount of compensation. So how this should be viewed in totality?
Yeah, you so again, this should be one of the factors in your due diligence, but this can't be the only factor. I mean, Murli Divi takes a lot of salary. Is he a good management or not a good management? Let the numbers speak. Check the cash flows that Divi's Labs was generating 20 years back. See where they are today. So the management compensation has to be looked into the context of what the business has delivered over a period of time. In certain industries, the results take longer to emerge. It's like an iceberg kind of in a story. So don't go by 1 year or 2 year. I think Jiten has got a point.
Yeah, I think I would rather like managements, good managements who take good remuneration than siphon, than managements who take lower remuneration but siphon a lot. That's my view. I think good managements have a right to be paid well because they do create wealth for all of us also. So I don't mind managements getting remunerated as much as the law permits and so on. Rather, I would uh, look at managements who won't siphon. That is more important for me.
Right, sir. So another question, like we talked about sugar industry and ethanol. So one question is around bulk alcohol and ENA manufacturing and the ancillary space to the sugar industry. So any view on this space, sir?
Um, it's difficult to call out. Again, there are, see, if the industry really takes off and you start reporting a high returns on capital employed, then you would be attracting competition. That's the nature of the beast, right? So if two three businesses are doing well in a certain segment, and they start reporting 3 4 5x asset turn, good ROC, um, good economics, etc., they will start attracting competition. Then the question would be how easy it is for the competitor to spoil the party. And if the entry barriers are lower, then the party will not sustain. So depending upon that, I think I tend to avoid any story where I'm going with an intention that I would have to get out ASAP. I don't go with that kind of a mindset.
Right, sir. So there is one question around, although not asking, which according to you has been the best and worst management and why?
Sorry, say that
Which
one
has
more
been
time.
the best or worst management as per you and why? So this question is
Best and worst in what context, in what sense, in terms of shareholders returns, or um, so in terms of shareholders returns, the best managements I've seen are in the chemicals space, in the IT space. I've been a big beneficiary of the chemicals, but not as much as on the IT side. But if you look at history of Indian markets in particular, only four sectors have compounded, maybe one or two more. So cement is an outlier. We have had cases like Sri Cement in the cement industry, where it was a very small nano micro cap in 90s, and it was listed back then. So that's probably an outlier. Maybe one or two more examples in the cement industry, but by and large only four sectors. So you have got IT services, you have got financials, you have got pharmaceuticals. Not so much in the last few years, but if you track 20-25 years of whether it's granules or divvies or even Lupin for that matter. Lupin was a very small company in late 90s. So pharmaceuticals, Sun Pharma. So pharmaceuticals is the third one, and finally the consumers. Both discretionary and more on the FMCG side. So the Britannias and the Nestle's of the world. So these are the four broad areas where a long story of compounding has happened, and chemicals recently have, if you look at the last 10 years of track record, I mean they have been very fast performers. I mean, many hundred baggers have emerged in the chemicals space in the last 10 years, but that doesn't mean that the next 10 years will also be mirroring the last 10 years. It seldom happens that way. And I see a lot of interest in the investor community when it comes to chemicals. um, this was not the case 5 years or maybe 7 years back. So, and again, if a new sector starts playing out well, it could be any other sector, then people generally tend to like that space more, because they people tend to get influenced by the recent past, what has happened in the last 1 year or 2 year. I'm not sure if that is the right approach or that should be the right criteria. But yeah, I think, yeah, those are the 4 5 pockets where, if you find the right valuation and right business, right management, then it it I mean, odds are in your favor that if you stay with that business, you will get rewarded. You won't be right on every investment, but on average you will be better off.
Right, sir. So, in the comments and DM, almost all of the relevant questions have been taken, apart from the ones which are asking for stock tips or so. And one question is like, Sajal sir, as we move in experience, like you have over 3 decades of experience. So, chances are like we make error of omission more than error of commission, right? So any recent example you have in your mind which you missed and could have been a good investment, or maybe if without naming also it will do.
Which I missed or would have been a good investment. See, in the current market, the way the correction has happened, it's difficult to call out one example where the stock has gone up 3 4 5x, and I missed that. I'm sure there are plenty. Um, Few pockets have done exceptionally well. CG Power, if I could name one. So Murugappa Group, they joined, and given their track record again. So that's what I say. History tells you pretty much all you need to know about the future. So there was a change in management, and the change in management in CG Group was a credible indicator, and the stock was dirt cheap. But this is all hindsight. But yes, and I was aware of that change, but because of my inflexibility to venture out of the consumers or chemicals or IT or pharmaceutical space, I kind of was hesitant. But the management change was a very big indicator that something great can happen, and the downside was limited. So again, this is Monish Babrai's, heads I win, tails I don't lose much. So CG Power few years back was one such example. um, and I've committed other mistakes. So majority of my mistakes have been in selling early. Stock is 2x 3x, even 4x, and I'm out, and then I miss the next 50x move, because the business economics were fundamentally strong. The management team kept reinvesting into newer growth opportunities, and the cash flows just kept compounding. So when you sell early on, out of fear or your lack of understanding of the business, you lose a lot potentially. Whereas even if you buy a stock at 300 and it comes to 50, um, and many stocks even in India have corrected 95%, even more. So Praj, as an example, in 90s, if you look at the historic charts, I mean, it corrected 95, 90, maybe 98%, if I'm not mistaken. And very few businesses have recovered. So there is always, for every Praj that recovered after crashing 98%, there are Punj Lloyds and Suzlons of the world, and there are Pentamedias and Silver Lines from the, or Satyams for that matter, right? So everything that crashes doesn't recovers and makes a new high. It's a game of probabilities and many other factors. But I would rather lose on not selling. So I've got this phobia of selling because of that. Because I made so many mistakes by selling early, I'm still in that sort of mindset that be sure 100%, 1000% before selling. But you do get those opportunities where you're better off exiting an existing position, because a better opportunity, a much cheaper opportunity with a better quality management is knocking on the doors. And in those cases, yes, it makes absolute sense to switch.
Right. One question is from Dr. Vimal. He's asking, in India, one of the only asset light model PSU in railway. It has got zero debt, more than 70% promoter stake, and operating margins and dividend yield is good, and they have handsome cash at the balance sheet. So his question is how one can play this, especially when reinvestment in the business is missing.
So that is a fundamental framework. So again, I want a business where ROE can be significantly better 5 years out or 3 years out. I want a business where I've got absolute confidence on the capability and the competence of the management team. And I want a business where the reinvestment runway is ultra long. So I'm not looking at the current ROE, because if the ROE is already respectable, then the valuations will also be. So Suven Pharma, as an example, was selling at 14 times price to sales because the numbers were out in the public domain. Everything was hunky dory. Or look at the recent IPOs. The reason these guys are coming out with an IPO is because they want to sell. And because they want to sell, they knew that they would be selling mm, years in advance, and they engineered the business. Not saying that there was any fraud or they cooked the accounts. There are many ways. So if you want, so take an API company in custom synthesis. If they want to come out with an IPO, they will do massive capacity expansion upfront, 5 years in advance, and they will only come out with the IPO when all those plants are up and running, because at that point in time, the true ROE and the true economics of the business would be out in the public domain, and nothing wrong in that. But if you assume that you can buy a business at 10 times price to book, a chemical or an API business, and you still can make a 10 bagger out of it, then I don't think so. I mean, I at least I have not seen too many cases where, buying a business at 10 times book. So Supriya Life Sciences got listed at about 10 to 12 times price to book, and there was a lot of some very good um, fund houses have invested in those IPOs, but it doesn't work out. The valuation is not in your favor. Whereas on the flip side, there have been many stories where the starting valuations were just one time sale, because the starting margins were low. But the scientific capability and the management competence and execution happened such that over the next 5 to 7 years, the margins improved, the ROE, ROCE improved, and the price to sales valuation significantly improved. It could be because of the same management. So SRF as one example. Look at the valuation of SRF 10 years back or 7 years back. Um, and again, no recommendation. I'm just using this as an example, guys. Um, so you have to go where the puck is going, not where it is today. Just by looking at what the current ROC is, what are the current margins or last quarter margins, that's all out in the public domain. You will not be able to make any alpha. You can still make some trading gains, 5, 10, 20%. But if you're looking for a large delta, then you have to buy ahead of the curve. And that's where you can only do that when you have got an end-to-end value chain analysis done, um, so that you are able to position early, and then when the real numbers start coming, you are well entrenched. I think Jitin has got a point.
So very well said. I think you make multi-baggers when there is a big change in ROE, ROC, and uh, if ROC is good and remains in that range, you make compounding returns. That's what happens. And coming to the point of some PSU, that I think the original question regarding that, having cash in hand. So one thing I would like to caution everybody is that when you look at the cash in the books of many of these PSUs, just make sure that you understand that quite a bit of it is advances from customers. So always do look at the liability side also. That is not actually cash. So just wanted to point that out.
Right, sir. And last question is on the metal sector. So, basically, what's your view on the metal sector at this point in time, and what are the risks always in place for the sector, and should be viewed seriously before investing in the sector?
So again, it's a game of it's a commodity, right? It's a global commodity. It's not just India commodity. Metals are a global commodity. London Metal Exchange price, you don't control the price. The best you can do is control the volumes. And so again, if you have got captive raw material, then it's just purely a function of price and the demand. The framework that I typically use with these cyclicals and commodities is I try to get them below their historic mean valuation. And it's very easy to find out what that historic mean valuation is. So in that auditorium session last year, I used the Tata Power as an example. So power is a very stable sector from a demand perspective. The demand is increasing at a healthy rate. So if the demand is increasing at a healthy rate, the new power plants are not coming at the same rate, then it should be like a Nestle or a Britannia in compounding. Why is there so much volatility? And the reason is the nature of the business, the capital intensity. You can't be increasing prices. It's a utility. So coming back to metals, you pick any metal, whether it's Hindalco as an example, or any other Tata Steel or whatever in India, and you look at their 15 year trend, because the rate of change is negligible in this industry, right? Not much changes in the metal sector. So historic valuations, you can take it as your friend. You can't do that with the chemicals or an API business, because the business itself may be changing. So the historic valuation may not be correct today. But in case of metals, the rate of change in that industry itself is so low that I can go and see what the valuations were on a 15-year mean basis. And if the valuations were, let's say, one time book, and if the stock is available at zero point 0.8 times book, and it has happened, in if you look historic valuations, 2016 as an example, look at the Q1 of 2016 across the metal companies, from Hindalco to Vedanta to Tata Steel, all of them. Um, they must have been either below their mean value or just about at their mean value of price to book. And the reason I'm saying price to book is because these are cyclical businesses. They will go through bouts of extreme profitability and losses, and PE therefore is not the valid criteria. In fact, if you are looking at the PE, do the opposite. If it's a very high PE, or the PE itself is not there because the company is in losses, that may be the time to take exposure. On the flip side, if the PE is too low, read it as the recent earnings last 4 quarters have been exceptionally good, and that's the reason the PE is low, and the base has been set for earnings disappointment going forward. So if you don't know how to play the PE game when it comes to commodities or any business for that matter, take the sector price to book value and look at this business from a price to book value perspective. Compare the two, sector versus this business, on price to book, because the cyclicality is taken care of by the book. If you're making losses, your book value will get adjusted. If you're making profits, your book value will get adjusted. So look at the sector price to book valuations, and also look at that business, and then see where the valuations are, and then you will be able to figure out whether the valuations are low. Now, even if the valuations are low and you take the exposure, doesn't mean that you will make money 1 year out, because bottom formation may take longer than you expect it to be. Tops are made very fast, within a matter of few days or weeks, whereas bottom formation may tire you out. It may drag on and on and on. I think we should definitely invite Jitin's view on this aspect.
So, very right. I mean, the thing is, P is the worst metric to look at in this kind of deep cyclicals in metals and all. So, price to book is definitely much better, or replacement cost is another method. These are the things which one should look at. And again, as I have said often in the past, I think you should sell when everything is very, very rosy. I've seen that because those times will not last. I mean, you can be a bit early in your selling, but that's fine because you can never match profitability, peak profitability and peak price. It will never coincide. So I think you have to sell early. That's what my philosophy is, and I've observed it over the years that your uh, peak prices will come much before the peak profitability because everybody is basically looking forward and making those assumptions and so on. So and I think last or in 2021 or something I said or last year it was probably when some of these companies were making spreads of 38,000 per ton. I had tweeted that time that this is not sustainable, and that was actually the top, to be honest. So same thing happened with graphite electrodes a couple of years back. So when your margins shoot up a lot abruptly, and then what happens is there is a demand breakdown because at those prices, a lot of industries will actually slow down. Your demand destruction happens, and so on. So then prices do come off. So this happens all the time. Uh, so again, as Sajal also said, yeah, the good time is to look at these companies when they are available at below their far below their price to book or mean price to book. So this is, I mean, there is, I'm seeing that there is no other way, in investing in these deep cyclicals apart from this. You can never know when the cycle is playing out. See, we all say in hindsight, okay, that this was the top and all that. But when the cycle is playing out, it is not that easy to recognize it and understand it, that yeah, this is the top and all that. It will never happen. So you have to make some adjustments, calibrations, some judgment that okay, some understanding from past cycles that these kind of prices are not sustainable. Another example is polyfilms. I have been waiting for some time for that. Also, that I have said that 20% margins in a commodity business like polyfilms is not sustainable. I mean, if you look at past history, uh, 12, 13, 14% is the highest margins they've gone in the past cycles. This time it went to 20% because, and I think COVID was the only reason that happened. But otherwise, if you understand the cycles and understand the industry well enough, you know that this will not sustain. So you have to, I mean, you don't have to get excited when these kind of margins are there. I mean, you can observe it, but then you need to plan your exits that time. You should never look at, PE, because PE will be very, very artificially low. And there's some simple smell checks. I mean, it might look stupid, but then when you see so many research reports coming on, price targets constantly being revised upwards and all this. I mean, these are some of the filters you can use, common, in layman terms, that will guide you to exits. So I believe, I think for us, entries have always been easier. Uh, of course, we've had to wait for the returns. Sometimes it takes 1 year, 2 years, nothing will happen, and then in the third year you will see a 5x and so on. This happens. So returns are not linear. So entering, and I have patience, so I can wait for 2 years. I don't mind at all for any returns and so on. But the exits are far more difficult because the mood on the street and is very, very different, and there is greed. There is a lot of talk of these stocks on social media. Technical analysts will give higher targets and so on. So many things will happen. That is, and as humans, and as psychology, it becomes very, very difficult to sell when these kind of targets are being given and so on. So you have to overcome that. I mean, it is completely behavioral trait to overcome this because there is greed on the street that point in time. So I hope I'm given a long answer, but I thought that I will bring that out, that selling is far more important in be metals or these highly cyclical companies.
Right, sir. Thank you for that. So, Sajal sir, like all the questions which seemed relevant were taken, and there are questions around pharma which we may be taking at a later time. So, before we close, anything further you want to tell our attendees, or I mean, we can wrap up the day? How?
No, I mean, the only thing that I would like to reiterate is, some of the key takeaways in terms of how we value the business, especially from a small cap perspective, where the future is uncertain and unpredictable, fragile, etc. You have to go through the history of that individual who is managing the show, because especially in case of small caps, um, it's is it's a function of that management and the core team around that person. So anything in that sub 5,000 crore market cap, which is relatively less tracked, you have to have a deep appreciation of the history of that management. Go with the management that have got the ethics, the capability, and the growth hungry mindset, and those managements should not be betting the house on that business in terms of taking too much leverage. So a reasonably leveraged balance sheet is a good one. So again, without recommending anything, just take IOL as a commodity business, right? The valuations are towards the low. Again, it may get cheap may get become cheaper. Don't get me wrong. So I'm not suggesting that the worst is behind, but you get the feeling that the margins are towards the end, and then you start interacting with the management. So I went on the the earnings call, the last earnings call, Q3, that is, and I asked, few questions. And those questions, the responses, they tell me something about the character and the mindset of the management. So I do it on purpose. And I did the same on the Heikel Q3 call. I did the same on Orchid Pharma. So many companies, I went to the investor call, and I asked, some questions, um, so that the responses could tell me about, the character, the competence, and the mindset of the management. And then I can figure out the valuation. That is all easy to do. So the point I'm trying to highlight is that the focus has to be on the management and only management. Everything else is a very small function. Even valuations, you are allowed to go wrong on valuations, but you are not allowed to go wrong on management. And if you discover that you have gone wrong on the management, um, have the courage to book loss, assuming that the stock is below what you paid, and move out. There is no point sitting and waiting, um, um, and partnering with a wrong set of people, so to speak. And again, lastly, just a repeat of the disclaimer again, that none of the stocks that we have mentioned is any sort of recommendation. Markets are seriously fragile, and anything can happen in the short term. So please do your own due diligence before
Uh,
trading on any
I
of these
cannot hear
specific
you,
items.
sir.
Can you not? Hello?
Is it me or
I
Jiten
think.
sir? Am I audible to you?
Yes, yes,
Yeah,
audible.
yeah. So I think, yeah, my voice should have been recorded, but yeah, I just repeat the disclaimer again, that none of what any one of us discussed on this session is any sort of recommendation. It's purely um, from the purpose of making us all a better informed decision. It's all a game of probabilities, and rarely do we make all the right calls. We make more mistakes than you might think we do. So take that uh, as a learning more than anything. Thank you.
Right. Thank you so much, sir. And guys, the session is recorded, and those who joined late may can surely refer to the recording. I'll be placing it over the YouTube. Also, it will be available on this Spaces link also. And once again, like as already said by the speakers, the session was purely educational and a starting point so as to do your due diligence. By no means a buy, sell, or hold recommendation on any names. The views are personal and they may change with a fraction of a second. Thank you so much, and surely we will keep you future.
Yeah, so I may also add that though I have not named any stocks, uh, just if even if I would have just wanted to say that obviously nothing should be treated as any recommendation. Uh, and thanks, Prince and Sajal Bhai, for letting me speak on this. I
No,
just happened to come by chance on this particular spaces.
no. The pleasure is all ours, Jiten. I mean, there's a lot to learn from the wisdom and your experience. So your presence enriched the session. Thank you.
Thank you. Bye.
Thank you.
Bye bye. Bye.
Bye.